In the world of investments, one often hears about CACOHD, SHIAG, and SHUS, but what do these terms mean, you may ask? Well, today we're about to embark on a journey to decode these financial acronyms. These are not mere jargon, but gateways to a better understanding of your investment strategy. You see, SHHG and SHIZ are types of exchange-traded funds, or ETFs as they're commonly known. Each of these ETFs offers a unique type of exposure to the market. SEHD, for instance, provides exposure to high dividend-yielding companies ensuring a steady cash flow. SCHG, on the other hand, focuses on growth stocks, equities that are expected to grow at an above-average rate. And SCHZ? It offers exposure to U.S. fixed income, providing a steady and reliable return. Over the next few minutes, we will delve into the nuances of these investment options. So buckle up and get ready to enhance your financial vocabulary and investment acumen. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us and remember to comment and share. Well, let's start with the basics. What exactly are ETFs? Exchange-traded funds, or ETFs, are investment vehicles that have taken the financial world by storm. Picture them as baskets of securities that are traded, just like individual stocks, on an exchange. These baskets can contain a variety of assets, including stocks, bonds, commodities, or a mix of investment types. The beauty of an ETF is that it allows you to invest in a broad portfolio of assets, providing the diversification that comes with mutual funds, but with the added benefit of daily liquidity, akin to individual stocks. Now, why are ETFs such a popular choice among investors? For starters, they offer an incredible amount of flexibility. With ETFs, you can gain exposure to entire sectors, industries, or even countries with a single purchase. Instead of picking and choosing individual stocks, you're essentially buying a slice of the market. Additionally, ETFs are well known for their cost efficiency. Because most ETFs are passively managed, tracking a specific index rather than trying to outperform the market, they often come with lower expense ratios compared to actively managed funds. This means more of your money goes towards your investment rather than towards management fees. Moreover, ETFs offer transparency. You can easily see what assets are in an ETF, and this information is updated daily. This transparent nature of ETFs allows investors to know exactly what they own at any given time. Lastly, ETFs provide tax efficiency. Due to their unique structure, investors can often avoid the capital gains tax hit that can occur with other types of funds. In the world of investing, knowledge is power. Understanding the basics of ETFs is the first step in empowering yourself to make informed investment decisions. Now that we have understood the basics, let's move on to our main topic. First up, we have SCHD, but what does it entail? Let's delve into the details. SCHD is an acronym that stands for Schwab U.S. Dividend Equity ETF. This is not just a random collection of letters. Each one tells us something about the fund's investment approach. SCHD is an exchange-traded fund, or ETF for short, that's managed by Charles Schwab. ETFs are investment funds traded on stock exchanges, much like individual stocks. They offer a way for investors to buy and sell a basket of assets without having to buy each component individually. The D in SCHD stands for dividends. This means the fund primarily invests in U.S. companies that have a strong track record of paying dividends. Dividends are a portion of a company's earnings that are paid out to shareholders, and they can be a great source of income for investors. But SCHD doesn't just focus on any dividend-paying companies. It targets those with high dividend yields. Yield is a measure of the income an investment generates each year relative to its price. So, a high yield means you're getting a lot of income for every dollar you've invested. On top of that, SCHD also seeks companies that have a stable cash flow. Cash flow is the net amount of cash and cash equivalents being transferred into and out of a business. A company with stable cash flow is often seen as a more reliable investment, because it's less likely to run into financial difficulties and more likely to keep paying those juicy dividends. In essence, SCHD offers a way to invest in a diversified portfolio of high-yielding, cash-rich U.S. companies, all with the convenience of trading a single stock. It's an attractive option for those seeking regular income from their investments, along with the potential for capital growth. So, that's SCHD for you. But what about SCHG and SCHG? Let's continue our journey through the alphabet soup of ETF investing and find out. Next we have SCHG and SCHZ, both intriguing, but how do they differ from SCHD? Diving into the world of SCHG, or the Schwab US Large Cap Growth ETF, we find a fund that places its emphasis on growth. It's all about the potential. It's about the fast-growing companies that are poised to make a significant impact in the market. This ETF provides a fantastic opportunity to gain exposure to these high-growth companies. On the other hand, we have SCHG, the Schwab US Aggregate Bond ETF. A stark contrast to SCHG, SCHZ focuses on fixed income. This fund is a collection of U.S. investment-grade bonds, which are essentially loans made by an investor to a borrower, typically corporate or governmental. The borrower then pays interest to the lender until the loan is paid off at the end of a set period. SCHZ is an excellent way to invest in these loans, providing a steady, reliable income stream. So, how do these two compare to our earlier discussed SCHD? Well, SCHD is about dividends, companies that share their profits with their investors. SCHG is about growth, companies that are rapidly expanding. And SCHZ is about fixed income, loans that pay out a steady income over time. Each ETF has its own unique approach. SCHD offers a steady flow of dividends, appealing to those who appreciate a consistent return. SCHG, with its focus on growth, might be attractive to those who are willing to take on a bit more risk for potentially higher returns. And SCHZ, with its focus on fixed income, is a great option for those seeking stability and predictability in their investment. As we have seen, SCHD, SCHG, and SCAZ offer different types of exposure. But which one should you go for? It all comes down to your personal investment goals, risk tolerance, and investment horizon. Stay tuned as we delve deeper into making the right choice for your investment portfolio. Choosing between SCHD, SCHG, and SCHZ can be tricky. But don't worry, we've got you covered. When it comes to making the right investment choice, there are a few key factors to consider. Firstly, your risk tolerance. SCHD, with its focus on dividend-paying stocks, provides a steady income stream and tends to be less volatile. SCHG, on the other hand, aims for high growth and could bring higher returns but with more risk. CCHZ, being a bond ETF, offers stability and regular income but lower growth potential. Understanding your capacity for risk can guide you towards the right ETF. Secondly, your investment goals. Are you looking for growth, income, or a combination of both? If it's growth you're after, SCHG might be your best bet. If you need a regular income, you might lean towards SCHD or CIs. If you're seeking a balance between income and growth, a mix of SCHD and SCHG could be the answer. Thirdly, your investment horizon. If you're young and have plenty of time before retirement, you might be able to afford more risk and go for growth with SCHG. If you're nearing retirement, you might prefer the stability of SCHZ or the income from SCHD. Also, consider the economic cycle. During a bull market, growth stocks in SCHG might outperform. In a bear market or a recession, the stability of SCHZ or the dividends from SCHD could be more beneficial. Lastly, diversification is key. No matter which ETF you choose, it should fit well within your overall portfolio, complementing your other investments and adding diversity. So there you have it. Risk tolerance, investment goals, time horizon, economic cycle, and diversification are all critical factors to consider when choosing between SCHD, SCHG, and SCZ. Remember, the right investment decision depends on your individual circumstances and financial goals. The most important thing is to stay informed, stay invested, and stay the course. Investing is a marathon, not a sprint, so take your time, make your choice, and let the power of compounding do its magic. We hope this video has given you a better understanding of SCHD, SCHG, and SCHZ. We've journeyed together through the basics of these funds, delving into how they offer unique opportunities for exposure to growth, cash flow, and fixed income, each with their own unique advantages. We started with SCHD, a fund that offers a steady stream of dividends, making it an attractive option for those seeking regular cash flow. Then we explored SCHG, a fund designed for those who are interested in capitalizing on the long-term growth of companies. Lastly, we examined SCHZ, a fund that provides exposure to fixed income, an essential component of any balanced portfolio. The choice between SCHD, SCHG, and SCHZ ultimately depends on your financial goals and risk tolerance. There's no one-size-fits-all answer, but a well-diversified portfolio can certainly benefit from the right mix of these funds. If you found this video helpful, don't forget to subscribe, like, and share. Stay tuned for more insightful content on investment topics.